Many investors hear about Series LLCs, but using one incorrectly can undermine the protection they're counting on. Hi, I'm Sherry Ayland, CPA and tax advisor. I help my clients pay little to no taxes using my zero tax blueprint. If you've spent any time in real estate investing communities, you've probably heard the term Series LLC come up. Maybe someone said it's the smartest way to protect multiple rental properties. Maybe you've heard it and had no idea what it actually means. Today, I'm going to explain it in plain English, what it is, how it works for real estate investors, why it can save you real money, and the one thing you need to understand before you go set one up. The standard advice for rental property investors is to put each property in its own LLC. That logic is solid. If a tenant sues over something at one property, the lawsuit stays inside that LLC. Your other properties are in separate entities sitting behind their own walls. But here's the reality of what that looks like as your portfolio grows. 5 properties means 5 LLCs. 10 properties means 10 LLCs. Each one needs its own formation filing, its own registered agent, its own bank account, and its own annual maintenance. Depending on your state, you could easily be spending several $1,000s a year just keeping all those entities in good standing before you've paid your CPA or your attorney anything. The Series LLC was designed to solve exactly that problem. You get the liability protection of multiple individual LLCs, each properly walled off from the others, but inside one single legal entity, one formation filing, one registered agent, one operating agreement, and depending on the ownership structure of your LLC, one tax return. And when you add a new property, you add a new slot inside the existing structure without going back to the state every time. Here is the simplest way to think about it. A Series LLC is like an apartment building. The building is one legal structure, but inside it, each unit is separate, its own walls, its own door, its own assets and liabilities. A problem in Unit 3B doesn't automatically reach Unit 7A. The building is one entity. The units are the series. In practice, you form one Series LLC and then create individual series inside it. Series A, Series B, Series C, and so on, each one holding a different property. A lawsuit at the property in Series A is contained within Series A. The properties in Series B and C are behind their own walls. The key thing to understand is that each series functions as if it were its own separate entity, its own assets, its own liabilities, its own bank account, even though legally everything lives under one roof. That's what makes it both powerful and something you need to set up and maintain carefully. Let me put some real numbers to this using Texas as an example. In Texas, forming an LLC costs $300 in state filing fees. Then you'll have a registered agent. Figure roughly $125 a year for a professional service. So for each individual LLC you form and maintain, you're looking at roughly $300 to set it up and about $125 a year ongoing. Now, multiply that across 5 properties. That's $1,500 just to form 5 separate LLCs, and roughly $625 a year to maintain them. Here's what the Series LLC changes. Using the same numbers, the formation fee for a Series LLC is the same as the regular LLC. There's no additional charge to set up the series structure. When you add a new property and create a new series inside the existing entity, you're not going back to the state. No new filing fee, no new registered agent. The only recurring cost is that $125 annual registered agent fee for the entire structure, regardless of how many series you have inside it. On a 10-property portfolio, the difference over 5 years between 10 individual LLCs and one Series LLC is real money, potentially several $1,000s that stays in your pocket instead of going to state fees and administrative overhead. This is the most important thing to understand about the Series LLC, and it's what most people skip over when they recommend it. The Series LLC is a creature of state law. It only exists in states that have specifically passed legislation to create it. Roughly 20 states have done this. Texas, Wyoming, Delaware, and Nevada, as well as Illinois, are among the most well-known. If your state is on that list and your portfolio is concentrated there, the Series LLC is a legitimate, powerful option, but not every state recognizes it. Arizona is a good example. Arizona does not have Series LLC legislation, and it does not recognize Series LLCs formed in other states. If you formed a Texas Series LLC and used one of its series to own a rental property in Arizona, you could be in trouble because an Arizona court handling a dispute isn't bound by Texas Series LLC statute. The walls you thought existed between your series may not hold up in Arizona's eyes. This is the core limitation. The Series LLC works cleanly when all your properties are in a state that recognizes the structure. The moment you cross into a state that doesn't, the protection becomes uncertain. For investors with portfolios concentrated in one series-friendly state, it's a great tool. For investors spread across multiple states, especially states without Series LLC recognition, the more traditional approach of individual LLCs is the safer path. Now, one thing that catches investors off guard with the Series LLC is that the administrative savings at the entity level don't eliminate the discipline required inside each series. Each series still needs its own bank account, not a sub-account, a generally separate account that reflects only that series activity. Each series needs its own records. Money moving between series needs to be documented. The walls between series are only as strong as the separation you maintain between them. If you commingle funds across series, running all your rental income into one account, paying all your expenses from one place, you've potentially collapsed the walls the structure was designed to create. A court looking at a dispute can see that and decide the series aren't really separate at all. The Series LLC reduces your administrative overhead at the entity maintenance level, does not reduce the discipline required at the operational level. You still have to run each property cleanly and separately. The structure just makes it less expensive to do so. I want to be clear about what this video is and isn't. This is an introduction, enough to understand what a Series LLC is and why it matters. It's not a substitute for a real conversation with a CPA and an attorney who know your state's specific laws and your specific situation. Here's when that conversation is worth having. If you already own multiple properties, or you're actively building toward that, and you're finding the overhead of individual LLCs adding up, ask your CPA or attorney whether a Series LLC makes sense for your state and your portfolio. If you're just getting started with one or two properties, you probably don't need this yet. Start with a properly maintained LLC in the state where your property is and revisit the structure as your portfolio grows. If your properties cross state lines, make sure whoever you're talking to understands how Series LLCs interact across different states, because that's where the structure needs the most careful planning. The Series LLC is a tool. Like any tool, it works well when it's the right one for the job. The question of whether it's right for yours is exactly what a good CPA and asset protection attorney are there to help you figure out. If this was helpful, subscribe to the channel and like the video. And check out our other videos, including the best entity structure for real estate investors. We'll see you next time.